Okay, let's get started. Hello, everyone. Thank you very much for joining today's WEFI seminar. And this is the last seminar before the summer. And we appreciate that you attend. And just a heads up, we're going to send out the call for papers for the fall semester. And we would like that if you have a paper that is relevant, please send to us. And today we're very, very happy to have Laurent Frésard to present the paper with Cecilia and Julien on knowledge cycles and corporate investment. And we will have Yufeng to discuss. And the format is as usual. We're going to have 40 minutes for presentation with possible answering questions and so on. Please put your questions in the chat box, and we will have 15 minutes for Yufeng to discuss. And then the rest is going to be left for on-floor Q&As. And with that, I'm going to turn the platform to Laurent and take it away.
Okay, perfect. Thanks a lot. Thanks a lot, Mike and Song, for taking the paper on the program. So let me jump right in. So we start with an observation. And the observation is the following, is that firms' technological knowledge follow cycles. I mean, it's not specific about firms. If I think about my knowledge, it also follows cycles. I learn something, I acquire knowledge, then I switch to something different, and then my knowledge goes down and is accumulated again. So just to motivate that a little bit in the context of corporations, in the figure here, you see a figure extracted from an HBS case that is widely used in strategy and innovation, and it's about Intel. And Intel is a prime example of a firms going through different knowledge cycles. So in the 70s, they were the champions of RAM chips, and then they had a very flourishing business, but then they faced competition. So all the knowledge that they've accumulated about this specific technology eroded a little bit, dissipated, and then their profits went down, and they had to, switch technology, invent something new, and they specialize into CPUs. They become the champion of CPUs. They accumulated tons of knowledge on that, and then other companies started to do the same. Their profit eroded, and so on and so forth. Okay, so you go through these cycles of knowledge, simply because knowledge dissipates, and you need to explore new technologies to be able to keep going and generate future profits. And so this means that knowledge at the firm level, follows cycles. And so when you start with an observations like this, you have lots of questions that, some of them are open. So one could be, what determines the explorations or the adoptions of new technologies? At what point the firms decide to do what Intel did and decided to go from a given technology, RAM chips, to CPUs? And then what is the length of knowledge cycles? Are they short? Are they long? What determines this length? So how does firms' value vary over knowledge cycles? We understand that, these cycles are driven by profits and the erosion of profits over time. So it's interesting to ask, what about value? At which stage of the cycle should firms invest most? At the beginning, in the middle, towards the end? Do investment and value move together, as you would expect in a neoclassical model, where investment is 100% driven or mapped to the value of the firm? And so if not, why? What could be the frictions or the stories for which there might be an imbalance between investment and value? So in this paper, we're going to try to shed light on some of these questions. And the main message, or the one that I would like you to remember at the end, is that knowledge cycles are important in general, but they're going to be important to understand corporate investment, when firms invest and the value associated with that. So this is the main takeaway. So now in order to do that, we're going to do two things. So we're going to start by developing a model. And so because we want to compare, we want to be in the space of investment models. So we're going to stay within a neoclassical model. So we're going to build from a typical neoclassical model of investment. And we're going to add what we believe are important ingredients if we want to think seriously about the process of knowledge creation within firms. And so we're going to start with a model of investment in which, typically from a neoclassical frame, investment can be thought as a way to accumulate capital. So capital is productive, and so the firms accumulate capital until it reaches the point where this extra marginal unit of capital becomes, productivity zero. But we're going to recognize that investment is not only a means to accumulate capital, but in our model or in our head, investment is also a means to accumulate knowledge. And so this is new. So for us, we see investment as a form of experimentation with the technology. Okay, so you have a given technology that you operate. So you will see that when I present the model. And so we're going to have a way to increase this knowledge by investing more. So investment or expanding capacity of the firm is as if you were expanding and running more and more and more experiments. And so you're going to be able to acquire knowledge through that channel. But because we want to stay very close to the notion of experimentation, we're going to make these experiments noisy, meaning that they're going to be trial and error. Like you and I, when we try something new, sometimes it works out. We realize that the outcome is good, so we keep going, and sometimes we realize that this is a dead end. Okay, so there's no future in this project. Okay, so the outcome of these experiments are going to be uncertain, and so this means that the process of accumulation of knowledge in the model is noisy, and this is going to be very different from the process of accumulating capital. When you accumulate capital, there's no noise. Okay, so you purchase a machine, you purchase a given unit of production, you pay for it. There's very little uncertainty about what you're going to get. With knowledge, it's very different. Okay, so there's a lot of uncertainty, and so this is going to make our paper very distinct from other papers that have tried to introduce the notion of knowledge capital or intangible capital in investment models. In these models, typically you choose a given amount of knowledge, and this knowledge has a pre-mapped function with production, profitability, and value. In our model, this is not the case. Okay, so this is going to be noisy, and so we go at the heart of trying to figure out how knowledge is created, accumulated within the firm. And so we're gonna think as investment as a knowledge channel. And so this is going to lead us to new predictions. And so we're going to have 3 of those. And so the first one is that investment is going to be high both very early at the beginning of a cycle. Just when you switch to a new technology, this is where you're going to invest a lot. But interestingly, we're going to show that it's also going to be high very late in the cycle. When you're about to switch to a new technology, you want to accelerate your investment. And this is new. So the second prediction, and I think this is going to be the most interesting one, is that the standard relationship between an investment and value, or investment and Q, the so-called investment Q sensitivity, investment Q relationship, is going to vary over the knowledge cycle, and is going to shift when the firms change its technology, when the firms start exploring a new technology. So around these knowledge resets, we're going to have a big shift in investment Q, and so this potentially could explain what we see in the aggregate, and I'm going to come back to that later. So the third thing that we have in the model is that we have these knowledge cycles that are, of course, endogenous in the model. They are 100% determined by value. They're going to be short, and we're going to be able to show that they're going to expand when knowledge is easier to protect. When intellectual property rights are very strong, okay, the erosion of your knowledge is going to be very, very slow, and so the length of these knowledge cycles is going to be long, and so investment Q sensitivity, as a result, will have a specific shape. So that's for the model. So then we're going to take these predictions to the data, and we're going to provide evidence supporting the importance of these knowledge cycles. So the way we're going to do it, we're going to use patterns to measure technological cycles and technological reset. So here we're inspired by a work of Song, using these patterns to try to measure knowledge base of firms and how they change over time. So we're not going to do exactly what Song did or does, but we're going to work into a similar spirit. So that's basically what we do. So let me jump to the model. So in the model, we're going to have a firm, just one firm, and this firm, in a very standard way, is going to combine capital K with a given technology. So you see here that the technology is indexed by N. So it is potentially a very large number of different technologies available that are that exist or that are non-existent yet. And so at a given point in time, the firm is operating one technology, N. And so with capital and this technology, the firm is going to produce an output. So this is very, very neoclassical. So now the productivity of the technology is going to evolve over time and is a function of M. M is the genuine quality of the technology. So if you have a higher M, the technology is more productive. Each unit of capital is going to translate into more output. The problem is that the firm does not observe the quality of the technology. It has a technology, but there's uncertainty about it. It doesn't know exactly whether technology is great or whether the technology is just good. So there is a noise associated with that. So the firm is observing the result of the production process, but it doesn't really know for sure the quality of the technology, which means that the firm is going to have to learn about it. And so we incorporate this noise with a simple noise parameter B here. I mean, it's in continuous time, so it's going to take the form of a Brownian motion. But this is not important. What's important is that the firm doesn't observe the true quality of the technology, but simply the realization of the outcome. So the firm is going to passively learn about the quality by observing productivity realization. So if you operate this capital, period after period, and you see that you have a lot of output, then you're going to conclude that the technology is good. If you have, meager production, you're going to conclude that the technology is not great. And at a given point in time, if you believe that the technology is not great, or if you believe that the technology maybe it's too good, you're going to decide to change. So how do you change the technology in a model? You're just going to say, stop. I don't want to use the current technology N anymore. I'm going to explore. And when you explore, you're going to draw, randomly from another technology. And so because it's totally random, you don't know whether the new technology that you pick is going to be good or bad. Okay. So this means that for us, in the standard baseline model, you're going to experience a knowledge reset. Okay, so there's no correlation between the technology that you have today and the one you pick. So we have an extension of the model where, of course, realistically, there is transferability of knowledge across technology. You don't necessarily start from scratch. So the quality of the technology M, N+1, and so on could be serially correlated. The implications are very, very similar. So I'm going to present the version of the model where when you switch technology, you forget everything and you start again from scratch. Okay. So you can learn, the firm can learn, as I said, about the quality of the technology it's operating by just waiting and observing realization. But what the firm can do, it can accelerate the speed of learning. And in order to accelerate the speed of learning, the firm can experiment. And for us, experimentation takes the form of investment. So every time the firm invests, increasing the scale of the amount of capital, the firm is going to receive a signal. And this signal is going to be S. So S is going to be a function of the investment. And again, it's going to be very noisy. So think about this S as a round of experiment. I invested $1 in extra capital. So if you think about having different machines, I'm going to run more machines. And as a result, I'm going to learn faster. Okay, so that's the spirit of this modelization. But as I said before, the outcome of experimentation is uncertain. So there's this other Brownian motion, which makes it sometimes very useful to experiment, but sometimes it's dangerous because it can take you on the wrong path. Okay, and you can stay on this wrong path for a while. So this tau S here, you can think of it as the experimentation technology. What does it mean? Think of it as the quality of your scientist. So the higher the quality, the more information you get from each round of experiments. So if you have superstar scientists, then every time you experiment, you have a high likelihood of learning something useful. If you have so-so scientists or so-so technologists, this tau coefficient is lower. And this experimentation technology is a bit more noisy. So that's what it means. Okay. So the firm is observing these two signals. Okay, it's observing the realization of what the firm does, the productivity realization, and is observing this extra signal that comes from the experiment. It's basically looking at the outcomes. And the firm is fully rational, so observing these two signals, the firm is going to form an estimate about the quality of the technology. So this estimate is going to be a t-stat. Okay, why a t-stat? For us, knowledge is going to be how confident you are that the technology is good or bad. So more knowledge means that you are more confident about the quality of the technology. Okay. And so this is basically a t-stat. So this is your estimate M hat about the quality of the technology, scaled by how uncertain you are about this quality. So it's very convenient. Why is it convenient? Because you have a simple formulation where knowledge, so we're going to call Z the stock of knowledge for the firm, is going to evolve over time as a function of passive learning. Okay, so this is you, the firm, passively observing realization of productivity and updating how confident you are that your technology is good or bad. It's going to be a function of how intensive are your experiments. So if you invest more, you have more experiments and you learn faster. And it's going to be a function of reset. At the moment you decide that the technology needs to be changed, you're going to have your knowledge going back to zero. Okay, so this is what is going to generate knowledge cycles. So the cycles are just the functions of passive learning, investment through experimentation, and the decision to switch technologies that we called exploration in a model. So this is how the process of knowledge functions in a model. So this is the novelty part of the model. Now we're going to put that into a neoclassical framework with one twist. So we're going to have a firm that is facing demand with a price elasticity. And so it's very standard revenue. So the revenue will be a function of how much it produces plus a parameter n. So this parameter n will be a reduced way to capture the impact of knowledge dissipation. So let me explain that in a very simple way. So when your knowledge is high, when you're confident that your technology is really, really good, this is when other firms are probably going to enter and dissipate your profits. Okay, so we capture that with this parameter phi here. And so this is a positive function. So the more knowledge you have, the better is the quality of your technology, the stronger the dissipation of your knowledge. If you operate a technology and nobody cares about it, you can operate it forever. You're not going to make much money out of it. If you discover something that's extremely profitable, then it's very likely that other companies will imitate and knowledge will dissipate faster. So investments is going to be subject to adjustment cost, so very standard in a very a quadratic function. And so here, I'm just saying it again, investment is a means to accumulate capital. So it's valuable for the firms to invest because you expand the scale of your firm, and because the technology is productive, it's going to lead you to more profit. But, and so this is the new thing, investment is also a way to accumulate knowledge, and this is also value enhancing. So you have these two roles of investment. We're going to put that in equilibrium and see what happens. So the last piece is that exploration is costly. So when you switch technology, we assume that a fraction of your capital becomes obsolete. Some of the machines you have, some of the buildings you had can maybe no longer be used. Okay, so you have an obsolescence cost associated with the switch of technology. Okay, so objective function of the firm. The firms want to maximize value. Value is simply going to be the discounted sum of net profits. So profits pi minus the adjustment cost of investment. And so the firm has to make two decisions. It has to decide when to switch technology. Okay, so it's a stopping time thing. And within each cycle, how much to invest at every given point in time. So if you solve for this model, you have the following. So here on the horizontal axis, you have knowledge. So 0 is when you have zero knowledge. 0 is the point here where you just started with a new technology. Okay, so you just draw a new technology, you know nothing about its quality. Okay, so you know absolutely nothing. So as you go along, you can accumulate knowledge on the right, meaning that you're going to start learning that the technology is good, or you can go on the left and you're going to learn that the technology is bad. Okay, so on the left, it's bad technology. On the right, it's good technology. It's going to take you some time to realize that it's bad. Okay, so when you realize that it's bad, after a while, you're going to switch. Okay, so here, when you reach that boundary, you're going to go back to 0 with a new technology. When you realize that the technology is good, you're going to continue investing until you reach that point here on the right, and you're going to switch technology again. Now, the question is, why do you switch technology if it's good? Simply because if you have a technology and it's very good, at some point, it's going to dissipate. Okay? So at some point, using the technology, the same technology forever is not optimal, simply because everybody's going to do the same. So you need to upgrade your technology to keep generating profit. So this is how it's gonna work. So now this is firm value. So you see that the value of the firm is highest upon exploration. So this is where the learning benefits are highest, the investment benefits are highest. So this is very standard. Okay, so this is how the value of the firm evolves as a function of the stock of knowledge that the firm has. Okay, so the important elements of the model is the notion of Q. So it's a neoclassical model. So Q is going to be what's driving investment. So in the model, we have total Q. So you see that total Q here, total Q is the marginal product of one unit of investment of capital is a function of knowledge. So it's going to be the traditional Q. Think of it as neoclassical Hayashi Q, plus what we call a knowledge Q. Why do we have a knowledge Q? Simply because in the model, investment creates knowledge. Okay, so there is a value added with one unit of capital in the form of learning faster. So total Q is, if you want, traditional Q plus knowledge Q. So you can think about this knowledge Q as Q associated with knowledge capital or intangible capital. So now let me represent this Q for good technology or bad technology, but let's focus on good technology. It doesn't really matter. So here in black, you have traditional Q as a function of the stock of knowledge. And so you see that this is just firm value. That's the graph I showed you before. So now in red here, you have total Q, where this knowledge Q is added. And so what you see is that it follows the same shape, very, very standard. It's a bit higher at the beginning of the cycle, simply because at the beginning of the cycle, the value of learning is high. Towards the end of the cycle, the value of learning is very low. Okay, so the deceleration is a bit faster. So now the main result of the model is the following. So the first thing we do in order to deliver this first model is that we switched experimentation. We totally switch experimentation. We make it 100% neoclassical model. So in this, if you want, in this benchmark model, investment is only a mean to accumulate capital. It doesn't create knowledge in any way. So what you have is that investment is just a function of Q. So in this world, investment is just following Q. So when Q is high, firms should invest a lot. When Q is low, firms should not invest a lot. And because Q is high at the beginning of the cycle and low at the end of the cycle, you should have the neoclassical prediction, which is invest a lot at the beginning of the cycle, don't invest at all when you're about to switch technologies. So now when we switch the experimentation channel on, when we allow investment to create knowledge, we have something different. Why do we have something different? Because investment is a function of Q as before, but it's also a function of the firm's attitude towards the noise that comes with experimentation. And so this is interesting because it makes Q not a sufficient statistic for investment. It's not a sufficient statistic investment because in firm value, there's not this attitude toward risky experimentation. So let me explain. At the beginning of the cycle, firm value is concave. So because firm value is concave, this term makes it that the firm doesn't want to invest too much. So experimentation is a risk that the firms want to avoid. So this kind of flattens the relationship between investment and Q. So now, towards the end of the cycle, firm value is convex. So what does it mean for firm value to be convex? It means that the firms want to accelerate investment. So investment could be thought of as a gamble towards the next technology. So you want to speed up. You want to be close to the finish line. So you want to speed this up. So you invest a lot. So now the interesting fact is that this is not captured by traditional Q or total Q. So this means that there is a wedge. And so this wedge is interesting. So in the model with experimentation, you have that investment is always lower simply because experimentation is risky. And so what you see is that investment is high early and late in the cycle. And so this is simply the result of having this investment creating knowledge and this experimentation being noisy, meaning resulting in trial and error. So this is a big departure from neoclassical models. So now we're going to try to see how big the departure is. And in order to do that, and because we want to take these new predictions to the data, we simply simulate the model many times. So we're going to simulate time series of investment and Q in the model. So once we have this simulation, we're going to follow the literature on investment Q, the whole literature on traditional investment, and we're going to track how the relationship between investment and Q varies around knowledge resets. Remember, resets are when the firm decides to switch from a technology to another one. And in order to do that in the model, we're gonna estimate this regression where we're gonna regress investment on Q, and in even time, we're gonna have a set of dummy variables that track years or periods before and after the knowledge reset. So now this is in the model. We haven't touched any data yet. And so that's what you find. So if you look in the middle here, so this is the baseline model, you have that the relationship between the investment and Q is the highest just before the firms switch its technology. So you see here that this is the benchmark. In the benchmark case, when investment does not create knowledge, investment Q is flat over the knowledge cycle. It doesn't change. So investment is just a way to accumulate capital. Okay, so there's no relationship over the knowledge cycle. So now when we switch experimentation on, you have first that investment Q sensitivity is not constant anymore. It varies over time. And in a very specific way, it's high just before firms switch technology, and then it drops. And so the reason is being at that point, the wedge between Q and what you cannot measure in Q, this attitude towards experimentation is the highest. So the wedge or the mismeasurement is highest. So now you see that if you play around with the model, I'm not going to spend too much time on that, but if you play around with the model and you make knowledge dissipation lower or higher, or if you make the experimentation technology better or worse, it affects, if you want, the level of investment in the cycle. It doesn't affect the shape. So you always have the same thing. Investment Q is very high just before the switch of technology, and then it drops. Okay. So the other things that we have in the model is that we have a closed form for the length of knowledge cycles. And so what you have here is the dashed line is the length of knowledge cycles when investment does not create knowledge. The solid black is when investment create knowledge. So you see that when investment is a mean to experiment and accumulate knowledge faster, the cycles are shorter. That's exactly what you expect. So now you also see that these cycles in the model, they are skewed. Okay, they're highly skewed. So when you have high dissipation, the cycles are short. So when many companies are imitating, or when intellectual property protection is weak, you need to switch technologies faster or more often, simply because your profits associated with a given technology are eroded faster. Okay, so here we have in the model that the cycles are endogenous, and their length depends on various parameters, and it's something that we can potentially, and that we will test when we look at the data. Okay, so let me go to the empirics. So the first challenge is to measure knowledge reset. And so here we're lucky to have the insight from Song when he presented his paper a few years ago, I believe, in Lugano. And so he came up with this idea where you can actually use pattern to measure the stock of knowledge at a firm, or the knowledge base. So we're gonna use that. So the data source, we're going to use patent data from the USPTO. So we focus on US public firms between 1976 and 2017. We're going to focus on firms that have at least one patent and available data on investment and total Q. So that's 1.4 million patents for more than 5,000 firms, 54,000 firm year observations. It's a pretty large panel. And to stay very close to the spirit of the model, we're going to use total Q from Peters and Taylor, which is Q associated with physical and intangible capital. And for us, investment will be physical plus intangible. Okay, so we're going to consider a firm F, and we're going to measure the knowledge base of that firm F at time t following Song. So we're going to look at the set of all the patents cited by the patents of firms F between a given window. So in the baseline test, we're going to take 5 years. So we're going to take a window of 5 years. We're going to look at all the patents that firm F has produced over the 5 years. We're going to look at what other patents these patents cite. And so the analogy is taken from Song is that my knowledge is given by all the papers I cite in my work. Okay, so this is one way to measure my stock of knowledge. So the way we're going to do it, we're going to calculate for each firm and year these vectors V. In these vectors V, we're going to assign the shares of F knowledge base in a given technology space. So we're going to look at the NBR subclasses. Okay, so here, these vectors F, they approximate the distributions of firms F knowledge at time t across diverse technologies. So some firms will have knowledge that are very concentrated in a given technology area, and some other firms will have knowledge that are very dispersed. This is based on the patents that are cited in the firm's F patents. And then we're going to calculate the evolution of the knowledge base of a firm using cosine similarity. So the way we're going to do it, we're going to calculate the cosine similarity between a firm's vector V at time t and t minus 1. So why do we do that? The cosine similarity is bounded between 0 and 1. So here, when delta V is 1 or close to 1, this would mean stable knowledge. Why? Because the distribution of knowledge base at time t and t minus 1 are very similar. So when you see that the cosine similarity between t and t minus 1 are close to 0 or very low, this means instability. This means that the new technology that the firms is developing is citing stuff that were never cited before. So we would interpret that as a break in the knowledge of that firm, technological knowledge of that firm. So with that, we're gonna identify resets, which corresponds to exploration in the model. In order to do that, we're gonna flag years where we observe a large drop in these cosine similarities. So we're gonna define knowledge reset for firm F at time t is equal to 1 if the cosine similarity is lower than the average minus theta times standard deviation. Okay, so theta could be 1, 1.5, 2, 2.5. What does it mean? If the firm is experiencing a cosine similarity or an instability measure that's very large compared to average, 1.5 standard deviation away, 2 standard deviation away compared to its own average, we're going to label that as a year during which the firm is experiencing a knowledge reset. So just to give you an idea about how it works, let me give you an example. So this is a company called CA Technology, and it turns out that based on our measure, it experienced a reset in 1997. Why 1997? So here I represent the V vector for that firm in 95, 96, 97. So for instance, in 95, the firm had 55% of the patents cited that were corresponding to material processing and handling technologies. In 96, the same. But what you see is that in 97, went from 55 and 53% to only 11%. Instead, in the technology space, computer hardware and software, it was 10% and it jumped to 43%. So if you look at the communication of that company, it's basically telling you that they changed the strategy in the mid-90s because they wanted to improve the compatibility of their product with other vendors, typically HP or Apple. And you see that in the types of patents they develop. Okay, so they develop new technology that is building on something they didn't do before. So for us, this corresponds to a knowledge reset. So we do that for all the firms in the sample. And so let me present you some summary stats. So you see that the similarity scores, so this is how stable these technology base are, this is very high. Remember, it's between 0 and 1. So on average, you have 0.96. Not very surprising. You don't have firms switching technology every year. So the resets, as a function of how big we require the jumps to be, are between 10% of the time and 4% of the time. Okay, so 4% of firm years are experiencing a reset. So now, conditionally on experiencing a reset, you see that the cosine similarity goes from 1 to 0.77, 0.68. So you don't have reset to 0. So this means that when a firms decide to switch technology, there is a reset that corresponds to about a third. Okay, so that's what it means. Okay. So when you look at the data, and you ask, what is the length of a cycle? We're going to look at the number of years between two resets. So of course, it's a limited sample because it requires to have firms for which you experience at least two resets. So how long has these cycles in the data? So depending on how big the shocks we require, you have that the cycles oscillate between 6 years and 9 years. If you look at the median, that's between 5 and 7 years. So it takes about 5 to 7 years for firms to experience a technology knowledge reset that would reset its knowledge for about 30%. So I don't know if you had any prior about the length of these cycles, but that's what we find in the data. So now if you look at the histograms of these resets and the length of these cycles as a function of theta, remember the magnitude of the shock we require, you see that the distribution is very skewed, and it looks very similar to what you have in the model. Okay, so you have these very skewed distributions, which is reassuring. So now let me show you just averages and medians across different sectors, different industries. So the longest cycles are in mining. The shortest cycles are in retail trade. So I don't know, again, if you had any prior, I would have expected that in retail trade, the cycles should be shorter. In industries where the assets are more long-lived or longer-lived, I would expect these cycles to be a little longer, and that's what you find as well in data. Okay. So now, how do we test the model prediction? Remember, the main prediction
Lauren,
was
5 more minutes. 5 more minutes.
Perfect. The prediction of the model was that investment Q sensitivity should not be constant over the knowledge cycle, but should exhibit a very, very clear pattern, should be high before the reset and low after the reset. So what we do, we look at the data and we run the exact same specification as we run in the model. So we have an exact mapping between the specification we run in the model and in the data. So we regress the investment of a firm on Q and the interaction between Q and these dummy variables that identify in either time, years before and after the resets. We have a firm fixed effect, so we want to look at within firm variation. And these coefficients, pi k, they really track investment Q sensitivity along the cycle. So that's what you find. So if you plot that between -5 years around before resets and +5 years after resets, what you have is that the investment Q sensitivity is highest just before the reset, and then it drops. This is exactly what you expect from the model. Remember, if you switch off this investment as a way to accumulate knowledge, this should be flat. Okay, it should be absolutely no variation. So here there is variation. The magnitude is pretty large. So this ±20% variation over this 10 years window. Remember, this is on average. Okay, so if you look at the difference between physical investment and intangible investment, there's no difference. You find exactly the same pattern. So now, alternative channels. So we worry about two things. One could be mechanical measurement effect. It could be that these breaks that we identify could be due to acquisitions, or it could be due to firms changing their patenting activity, patenting more, patenting less. It could also be due to things that matter for investment Q models that are outside of the models. Could be financial frictions, could be competitions, it could be corporate governance, market pressure, institutional ownerships, and so on. So what do we do to assess whether this could potentially explain the result? We do, econometrics from the 80s. We do sample splits. Okay, and we try to see what happens. I like the 80s. Okay, maybe that's because I was born in the 80s. Okay, so here, if you split into firms that do make acquisitions around reset and firms that don't, firms that do change the size of their patent portfolio around resets and firms that don't, you don't see much difference. Okay, the patterns are exactly the same as before. Investment Q is high before resets, it drops after reset. So if you look at different groups based on financial flexibility, cash over assets, different groups based on HHI, different groups based on institutional ownership, you see the same patterns. If you run a regression when you throw everything in, all the controls, you find exactly the same patterns. So it doesn't seem that this is driven by this mechanical effect. So now, I would say it's not that surprising because the way we define resets is kind of very specific. Okay. So the last thing I want to show you, this is not out of the model, so it's just speculative at this point. So what we've done is that we just, consider the aggregate evolution of the length of cycles. between 1980s and 2017. And what you see is that cycles have become longer. So the length of cycles has gone up. So on the right-hand side, you have the incidence of resets. And so you see that the incidence of reset is going down. If you have longer cycles, of course, you're going to have less resets. So now this is interesting. Why? Because it has been shown by other research that investment Q relationship is going down over time. Okay, so there's a lot of debate on why. And so we believe this could be one explanation. Why is that the case? Because we just said that investment Q is very high just before reset. So if you have less and less reset in the aggregate, it's not very surprising that the strength of the aggregate investment Q sensitivity should be lower. So now we are in the process of investigating that a little bit more rigorously, but we believe this is interesting. So now this lengthening of cycle is also interesting in the light of some results in the literature that indicates that new ideas are getting harder to get. So if it's becoming more and more difficult to find new things, you would expect that these cycles are becoming longer. It's also a possibility that competition plays a role. We have literature indicating that markups are going up, rents are going up. This means that there's very little incentive for firms to innovate and develop these new technologies. So we're in the process of trying to putting that all together. So let me conclude. So main takeaways: investment in Qs vary over knowledge cycles in the model and maybe more importantly in the data. So we believe that this is because of a new economic trade-off and the idea that investment is not only a mean to accumulate capital, but also a mean to learn faster and accumulate knowledge. So investment Q sensitivity varies over cycle. This relation is flat without the knowledge cycle. Knowledge resets seem to be important in the data. They seem to mark a very clear shift in this investment Q sensitivity. We didn't know that before. It's very high before reset, goes down after reset. We test that and we find consistent evidence. So as I said, main takeaway from this paper, because before you go on your summer break, knowledge cycle are important. There's many things we don't know, and we hope that this is going to stimulate more research on that. Thank you.
Thank you very much, Laurent, for a very clear and insightful presentation. So now it's time to have our discussion, and our discussant is Yufeng Wu from UIUC. Take it away, Yufeng.
Okay, great. Could you hear me? Okay, perfect. Thanks a lot for inviting me to discuss this super interesting paper. It's a very interesting reading for me. So in the paper, the authors look at how firms invest along their knowledge cycles. And on the theoretical side, the authors show that they build a Q-theory model with knowledge cycles, where firms can experiment, they can explore, and knowledge also dissipate. And all these actions are going to change along the cycles. And as a result, it drives corresponding changes in the measured investment Q relation. And on the empirical side, the authors construct measures for this knowledge cycle using pattern data. And they show that in the data, the investment Q relation, how does it vary across along the cycle, it is also consistent with the predictions that they get from the model. Okay, so let me start by summarizing the model. So here I'm going to start with the simplest possible case, and I will try to add this additional modeling ingredients into the model one by one and show how that is going to change the model predictions. So we start with a simple dynamic investment model where a firm produces and gets some profit, which is this pi. And the profit equals the price times AK alpha, which is the output. And here K depreciates and the firm can pay to make investment. And for this A, which is the productivity, it depends critically on two things. So first, it depends on what is the technology that the company is operating. So if you're operating better quality technology, that means the growth rate in your productivity is going to be higher. And second, there is also a very important ingredient, that is the conditional variance of this technological quality. So this means at a given point in time, if you're more confident, your estimate about this quality is more precise, that means the conditional variance is smaller. That means it helps to boost the growth rate of your technology. So on the other hand, if you are more uncertain about what is the quality and your estimate have a larger variance, then it's going to enter as a scaling factor, which slows down the growth rate of the technology. Okay, so this is how this productivity is formulated in this model. At day zero, the firm is going to, at day zero means the start of a knowledge cycle. So the firm will get a random draw from a common distribution and get a technology. And for this technology, the quality is not observable by anyone. And at the start, this conditional variance is fixed. And over time, the firm observes what is my output. And because my output depends on this technology quality, so the firm can learn from this output over time. And gradually, the firm will update what is my belief about this quality and what is the conditional variance in my estimation. Okay. And following this idea, the authors define knowledge as this perceived quality scaled by square root of the conditional variance. So this is because first, this is the outcome of the firm's learning process. And the second, it controls the growth rate of the productivity. So that kind of maps into this idea of knowledge. And in the setting, the authors show that the optimal investment is defined as the depreciation rate plus Q scaled by a gamma, which is the investment cost. Meaning that this is the classical Q theory because Q explains all your decisions about investment. Okay, so next we're going to add exploration into the model, meaning that the firm can abandon the current technology and get a reset. Okay, so this implies that the firm will get a reset if the current knowledge is too low, because at that point it's better for the firm to get a fresh start. And then we add knowledge dissipation into the model, which means the price growth is going to be negatively related to the square root of your knowledge. So if you have a lot of knowledge, that's going to slow down the growth rate of the price. Okay? So this means the firm will also want to explore, get a fresh start if the knowledge is too high, because in this case, the contribution to productivity is not sufficient to offset this growth rate on price. And 1 + 2 in the model defines the knowledge cycle, which is basically the intervals between 2 consecutive rounds of exploration. Okay, and lastly, the authors, they add experimentation into the model, which means the firm can get an additional noisy signal about what is the quality of the technology. And here, one important feature is the precision of this additional signal is going to depend on the firm's investment. So if you invest more, that allows you to get more precise signal. Okay. And here, this experimentation also contributes to knowledge, because remember, knowledge is defined as your perceived technological quality divided by the conditional variance. And having this additional signal is going to help you to get more information on that. Okay. Okay, so this is the model. And from the summary, we can see that in the model, investment serves a dual role. So first, it has this traditional role, which is to increase capital. And in addition, investment also influences knowledge accumulation in a noisy way, because it allows you to get a noisy signal about what is the quality of your technology. Okay. So this means in the model, the firm's optimal investment decision is going to be such that the firms will invest to the extent that the marginal cost of the investment will be the traditional Q plus something additional. So the first item here, which is the part highlighted in red, that captures how investment is going to influence knowledge. And the authors label this as the knowledge Q. And because the investment influences knowledge in a noisy way, so there's going to be a second term, which is the term in blue, that captures the value of this noisiness. And the authors label this as the attitude towards noisy experimentation. And 1+2 defines this knowledge channel in addition to this traditional role of investment in this model. And one important takeaway from this decision rule that I characterized here is that, so here Q is no longer the sufficient statistics for investment because we have the two additional elements. And especially we have the second element, which captures your attitude towards noisy experimentation. And it's something that is very difficult for us to measure directly from the data. And that drives a wedge. Okay. To show this idea, the authors plot how this investment Q relation changes around this reset of a knowledge cycle, which is a time zero. And as we can see, it is higher before the reset, and it decreases and becomes much lower after the reset. Okay. And to test this idea in the data, then we'll move on to this empirical part. And the authors start by defining this vector V, which captures the patent from different classes cited by a given firm in year t-5 to t. Okay. And then the authors calculate what is the cosine similarity between V of this year and V of the previous year. And the authors identify the firm years where the similarity measure is a few standard deviations below the mean. So if if the similarity of the patent citations for me in this year and the previous year is 2 standard deviations above the average of the firms, then the authors, they're going to label this year as the start of a new knowledge cycle because the knowledge that you are utilizing becomes very different from what you used to have. And they run a similar regression that examines this investment Q sensitivity, and we get a consistent prediction as what the model says. That is, this sensitivity becomes much lower after the knowledge reset, which is the red line here. Okay, so this is the paper. So first of all, this is a very interesting and rich paper to read. So here I'm not able to summarize all the important results in the paper, and I don't think Laurent summarized all the important results. There are a lot more in the paper, and I highly recommend that you go and read it yourself. And the paper aims to explore more features of the knowledge investment, like what is the cycle, or I have a paper with Song where we look at what is the scope of a knowledge investment, in addition to what is just the optimal level, which I think is a very promising field. And the authors built a model with a lot of novel ingredients to conceptualize this idea of a knowledge cycle. And the authors, they also construct empirical measures, which I think is a very clever way to do this measure, which delivers quantitative results that are quite comparable to the model's prediction, which I think is a lot to ask for a model of this kind. Okay, so in my discussion, I'm going to focus primarily on 3 aspects. So first, I will talk about, given that there's a lot of novel ingredients, so I would like to talk about how to benchmark this model against some existing works, and hopefully can help the readers to better understand what is the importance of this novel ingredient. And second, I'll talk about measurement of Q, because the central result is about investment Q. So I think this is a discussion that we just cannot get around. And lastly, I will offer some additional thoughts. Okay, first, the model. When I try to think about a close benchmark in the literature, I think the studies that I find most related to this idea is the papers that talk about how firm policies would change over product life cycles. So here I cite some papers in the IO and in the finance literature. So this got me really curious. What are the relationships between the 2 cycles, the knowledge cycle and the product life cycle? Are they capturing the same aspect or different aspect of a firm? Or it may be that the 2 overlap, and these technological changes, they are actually driving forces for the changes in the product life cycles. So I think in either way, it's going to be super interesting for the authors to discuss what is the relation. And second, I also compare the differences in the specific modeling choices. So in that literature, it is usually modeled as the firms make investment in order to explore profitable and new technologies. And if you invest more intensively, then there is a higher likelihood that you are going to get a new idea, a profitable new idea. And in this paper, the modeling choice is slightly different. It's a different mechanism in the sense that we're looking at firms invest to reduce the conditional variance of the current technology. And once you're sufficiently convinced that this is not a good technology, then you switch and get another technology with unknown quality. So I think the mechanism is different and it's definitely plausible. But I would like to see more direct evidence on this learning boosts profit through reducing this conditional variance channel. And in addition to this investment Q relation, I think it would be really interesting if the authors can show the behaviors of a broader set of variables. For example, what is the level of the investment? What is the level of firm value? What is the level of patent citation over the knowledge cycles? And I think that will provide some additional support to this specific mechanism.
You've only got 2 more minutes.
Yeah, sure. So my next comment is on the measurement of Q. So one of the central results in this paper is accounting for this knowledge cycle really helps us to better understand this investment Q relation. And I think in order to make this argument even stronger, there are a few things that authors can consider. So first, in the literature, we know that there are some econometric techniques that can help to correct for approximately additive measurement errors in Q. And I think it's helpful if the authors can show that somehow this missing term is not just an additive measurement error. So it is really important for us to have this full model with all the details in order for us to correct for this potential bias. And second, there are some definition inconsistencies in the definition of Q. So I think in the paper, the authors, they are talking about, in the model, the authors are talking about the marginal Q, and everything is scaled by the firm's profit. And when we construct this measure in the data, it's oftentimes the average Q, and the denominator is the firm's asset, which is the conventional thing. So I think at least when authors, they are comparing this model prediction with the data in terms of the investment Q relationship and how that varies along the knowledge cycle, it's useful to discuss how does this difference in measurement play a role there, or it's helpful to keep the measurement consistent. And third, I think when people talk about this investment Q relationship or the Q theory, it's not just an argument about the coefficient. It's also about explanatory power. So I want to see if there is some supportive evidence regarding how this explanatory power of this Q changes over this knowledge cycle, which I think will be a nice piece of complementary evidence. And last, I want to see some exercise on some placebos on this, how investment Q changes over cycles. For example, this is more like 21st century econometrics. We want to see, for example, if you define a placebo knowledge cycle, not just using the patent citation changes, but for example, some abrupt changes in the firm's investment level or the firm's financing policies, how does this investment Q relation change after the reset of this fake knowledge cycle, and see if the patterns are different from what we have discovered in an empirical exercise in the paper. Okay, so last slide, and I will wrap up in a minute. So this is related to not specifics about the paper, but something that I personally find very interesting, just in the paper's topic in general. I think the paper touches on a very important idea, which is how this investment Q relation change over time. And in the literature, we have some good answers, which point to things, for example, intangible investment, there's risk, and there is the argument on competition. And if you look at these answers carefully, actually, they all seem to be related to these changes in this more fundamental experimentation process. So I kind of wonder to what degree we can use this takeaway or this insights from this paper as a micro foundation for these mechanisms. And I wonder to what degree the effect that we discover here regarding investment Q can be related to these very specific mechanisms. And in addition, this discussion, the previous discussion has focused primarily on this time series dimension. So what explains this change in investment Q relation over time, as the author has mentioned in the last slide. So I would like to see, can we go from like a more micro to more macro level? So maybe for a given firm, as the different economics primitives change, there is a change in their knowledge cycles. And there might be some extensive change. For example, for the firms exiting the economy and for the entrant firms, they have different knowledge cycles. So we want to see like to what degree this can explain this this time series change in the investment Q relation that we have observed, which I think is a quantitative exercise, and it's going to be super exciting if the authors can bring this insight into that discussion. So that's all I want to say. I think this is an interesting and very rich paper, and I highly recommend everyone to read it.
Thank you very much, Yufeng. And Laurent, do you want to take a few seconds to respond, and then we can open up the floor for more questions from the audience?
Yes, thanks. Thanks a lot, Yufeng. So this was a fantastic discussion. So I think next time I present a paper, I think I should use your slides. Yeah, actually more to the point. So it was very useful. Now, honestly, all the points are well taken. So there are things that we did, in previous iterations of that paper on measurement error. So measurement error, Ericsson, Whitey, this and that. So we have the results. We decided not to put them in a paper because we thought it was a bit too much, but I think it's a good idea. I mean, so this is very helpful. It's also a good idea, I think, based on your comment, for me to upgrade my econometric skills from the 80s to the 21st century. So I need to start a new econometric cycle. I think that's one takeaway. I agree on the the link with product cycle. This is a tricky one. So you can, it's a tricky one in a sense that, it's always been hard for me to figure out what's the link between a given technology and a product, and how these two are, articulated. I don't want to jump to conclusions saying that, yes, there should be an overlap, or the overlap should be asymmetric or asynchronous. I mean, I think it requires more micro foundation to make that link, and maybe a richer model. But I think it's a very good idea. On the empirical side, there's something we can do. And so for the macro interpretation, I think this is where we're going. We're trying to be careful. Not, for the moment, we don't have, if you want, the tools to make strong statements. So we hide a little bit, to be honest, under making speculative statements, speculations. But of course, our goal is to be more affirmative on this, but we're working on that. So thanks a lot for wonderful discussion.